And Jason.
All right, so welcome to our monthly multifamily investors meetup. I want to introduce our first announcer, Michael Ashley.
Hey, how's everybody doing today? Y'all doing good? Awesome. Glad to have y'all here today. So we are gonna get this meeting kicked off, started. First off, we wanted to make an announcement right now. We're actually looking for sponsors for food and parking. So if anybody's interested in giving sponsors for snacks, food, parking, wink, wink, Wakefield. Yeah, so yeah, anybody interested in that? And of course, you know, you guys get some benefits to promote those as well. So yeah, definitely keep that in mind. So we have a very special guest here today. We'd like to introduce our speaker, Wakefield Li. He's actually the managing principal at Meridian Real Estate Partners. He's helped grow assets under management to over $10 billion. Pretty, you know, big deal, I think so. And in just several years. He's worked with pretty big companies, CV Richard Ellis, Marcus and Millichap, Price Waterhouse Coopers. Yeah, his presentation today is going to be on how to be a smart passive investor. So without further ado.
Slide. Yeah. Okay. Great. Good evening, everyone. How's everyone doing tonight? Good. What's up? Yeah, thank you all for coming, spending some time here this evening, and hopefully that will be valuable and you'll get to learn something today. Who likes to do a lot of work? Basic, okay. One guy likes to do a lot. Who likes to do less work and make the same amount or more money? Okay, almost everybody, not quite everybody. We're here tonight to talk about how you can be investing without doing. Next slide, please. So tonight, a little bit about our agenda. We'll talk about the team, which right now is just me. But I have other people working with me on projects. Why invest and what is a syndication? So some of you might already know what that is, and some of you might that might be new for you. So we'll talk about what that means. Mainly, we invest in multifamily. We think it's one of the best asset classes out there. We'll talk a little bit about what it is. You probably know what it is, apartment buildings, why it's a good asset class, stable to get involved with, and different ways to invest. You could do it yourself, you could work with somebody else to do it, you could partner. What are the different ways to get involved with it? Market research is always important, even though you say, hey, I want to do apartments, how do you know where to invest exactly? So there's a little bit of some research involved in that to figure out what is a good place to place your investment. And then if we have time, we'll do a case study, a project that we got involved with last year. We closed that project and could share more information about what that looked like, what the process was to do that one. And we'll leave some time for questions and answers at the end of it. Next, please. A little bit about my background. Thank you for that introduction. I am from the Los Angeles area. I grew up actually in San Gabriel Valley, a little bit more east. I went to USC, actually studied finance for my undergrad, and then eventually I did my MBA also at USC, focused in real estate. I've been in the real estate industry for my career. So about 11 or 12 years, I started in real estate consulting, Price Waterhouse Coopers, where I did office buildings, apartments, all kinds of things. Worked in brokerage at CBRE, Marcus Millichap, And then eventually I said, how do I get into investing? So I worked at a company that invested in pretty big projects. So they're a private equity firm, and there I helped to grow their portfolio to about 10 billion. I think they're at maybe 6 or 7 billion. They were buying malls, if you know Westfield. So pretty big projects that I got to be involved with and learn a lot there. The company that I founded is called Meridian Real Estate Partners. And what we do is invest in multifamily properties, and our strategy is to reposition these properties. A lot of them are owned by maybe mom and pops or different owners that haven't really maximized the value. And what we do is renovate. We figure out different ways to improve the value, get the income up, and over the next few years for investors. So why invest? There's a couple of reasons here. What are the benefits, and how do you make a profit in real estate? So one is by principal and loan pay down. Now some of you might do cash, maybe buy a flip, you buy it all cash, and so you don't quite have that loan. With multifamily, usually you're putting on some type of long-term loan. That could be 3 years, 5 years, 7 years, 10 years. And what you're doing is having your tenants basically pay down your loan. At the end of 3 years or 5 years, they'll help you to pay down that principal, and you'll actually own more of the property. Second one is appreciation. So as most of you know, real estate tends to go up over time. You'll have a cycle, it'll go up, it'll go down, but over a long-term period, usually real estate will go up in value. You'll get cash flow. So just like a stock, some of you guys might have stocks, you'll get cash flow. And where's that cash flow coming from? Typically tenants are going to be paying you rent. And finally, tax benefits, which is a big one. So talk a little bit more about that. Tax benefits in real estate, because of depreciation, write-offs, different benefits that way. You can actually pay minimal, in some cases no taxes on your gains. So you have a set of deductions here. Some of you might be real estate professionals, and if you have that kind of status, you can get even more benefits right off your phone bills, your car bills, etc. Also, you can do something called a 1031 exchange. Let's say you sell your investment and you made a profit on it. Normally you pay some type of gain on that or tax on that gain. But if you do a 1031, you can actually defer that gain. And that's actually a way a lot of people build their wealth over time. You'll buy maybe 5 units or 10 units, and then that appreciates over 5 or 10 years, and you get into maybe 20 or 50 or 100. So that's a pretty powerful move. Self-directed IRAs, 401ks. So that's another way for people to have another type of investment besides the stock market. You can have a self-directed IRA and put it into real estate investment, a syndication, or other type of project, and invest that way as well. So a little bit about syndication. Is anyone totally new to syndication, or people generally new? Okay, great. So kind of just give you an overview here. So what is a structure? It's kind of an interesting word. So syndication basically means you have, for example, a real estate project, and you have different people that are involved. Now, what's called the sponsor is the person that does most of the work. So they will find the property for you. They will negotiate it, get it under contract. They will do all the due diligence, figure out what is this worth? What is it going to make? Is this even a good project? So that's called the sponsor, or they call it GP, the general partner. That group, or can be an individual, or usually it's a group of individuals depending on the size of the project. They will basically put that opportunity together and say, here you go, here is an investment opportunity. Now that's one role. The other role is the investor. Now, where the passive part comes in, how you get involved as an investor is basically by getting involved in an opportunity and investing your funds. So that can be cash, that can be retirement funds, etc. And what you're doing here is contributing most of the capital. Different structures are set up a little bit differently. Typically you'll have a sponsor that is investing with the LP at the same time. So it could be 10% of the partners that are investing, or 20% of the investment capital that the partners are investing, or even 5%. So various different ways, but the point of the syndication is that the GPs are creating this offering and then bringing in the investors who don't really have to do the work, but they will be participating in it passively. So what is the benefit of syndication? A couple of reasons here. You can take advantage of an economy of scale. So for example, you might have an option to say, well, I'm going to buy a 2-unit here or a 5-unit here. And that's good. That can be a great investment, but it might be harder to say as one person, you want to buy 30 or 50 or 100. So when you work together in a group, basically, that's what a syndication is a group of investors putting their funds together and saying, hey, let's buy something bigger. You can acquire more properties and build your wealth over the long term. The T's, I don't know if you guys have heard of the T's, so no toilets, tenants, and trash. So if you don't want to be a landlord anymore or do that kind of work, this syndication is kind of offers you that opportunity to not have to do all the day-to-day stuff. More time, more freedom when you're not trying to look for properties all the time or drive around and figure out how to do it yourself. That just kind of frees up a lot of your personal time and resources. So retirement is also a big one. A lot of people see this as some diversification from the stock market, right? So if you have your W-2 job and you're making some contribution to your 401k or IRA, Roth IRA, et cetera, this is a pretty nice way to get diversified and have some exposure to real estate. And then, as I said, with the 1031, what people do is they'll get involved in a project for 3 or 5 years and just keep rolling that to the next project. So multifamily and how it works. Came up with a couple of reasons of why what's the benefit of investing in multifamily. So the research shows over a long period that multifamily has performed pretty well. Now, we all know there are market cycles, right? Markets go up, markets go down. But according to research over 10, 20-year period, multifamily has basically done the best across, industrial buildings, retail buildings, office buildings. And that's why that kind of leads to the third point over here is that the interest rates are quite competitive. So you'll have, if any of you have heard of agency lending, which is almost like a quasi-government type of loan. The reason that more attractive financing is available is because of strong performance over time. Resilient to economic downturns. So, over time, you might have some kind of dip, but over time, multifamily tends to keep holding value, especially if it's located in the right place. And short leases, so if any of you have done maybe triple net or retail, those leases tend to be a little bit longer, 3 years, 5 years, 10 years. Those are also good passive opportunities as well. But basically in general, once you buy that, you're sort of locked in. Versus with a lease, one common method that we'll talk about later is value add. So if your rents are low and tenants are month to month or 1-year lease, you can actually get their rents up within 12 months versus having to wait 5, 7, 10 years. So here are a couple strategies. So nice thing about multifamily is you can buy it and it's sort of, this is how it's performing and the goal is to get it to the next level, right? In general, what we're trying to do is provide clean, safe living conditions for tenants, call them customers and clients, improve their quality of life. So as we do these renovations, they're, nicer flooring, nicer paint. Sometimes buildings aren't maintained well and, maybe your parking is not that great or, just doesn't look that nice. Your landscaping is not great. So really trying to add value to these buildings and improve quality of life for tenants. Generally speaking, if you guys have been renters or, in the past, if the landlord takes care of your building, you probably will be happier. And taking care of any deferred maintenance, sometimes we'll see some properties that need a roof to be replaced, right? That's not always a great thing for a tenant if, you have leaks and things like that. So taking care of these things is always good for the property and adds the value over the long run. A lot of properties that we see too, depending on where it is, they don't have professional management. It might be a person that's owned it for 5, 10, or 20 years, and they're maybe a professional and they just are trying to do this by themselves or call a handyman. And because they're not full-time and focused on it, they might not be providing the best service. One of our strategies is to put in professional management. When you have professional management, you have dedicated staff that are doing maintenance and leasing and providing quality of service, so your tenants are having a good experience. Here are a couple of things that we tend to look for. So I think we have 4 steps here in evaluation process. And different people have different criteria. This is just a suggestion, and sometimes what we look for, we are looking at other people's projects of, hey, do we want to work with them? The first one is evaluating the team. What has this sponsor or this GP done? What is their track record? Have they done projects like this before? Do they know this market? Are they familiar with it? If they have current projects, how are those performing? So, you'll look at their past performance and say, well, they've done this in the past and it worked out well, and hopefully they're going to be able to do that in the future. And second one is market. So how do you know if these markets are good? So you'll look at a number of different data sources. I won't get into all of them here, but there's a good handful. Looking at the past 2, 3, 5 years, is population growing? Are there more jobs being created here? Who are the employers? Is it very focused on one industry? Maybe it's military. Maybe it's oil and gas. Or is there healthcare and technology and lots of different industries? So you're not just focused on one. Is it in the path of progress? So is the city very development friendly? Do you see other development projects going up? Are apartments being built? Are new retail centers being built? What's the local activity going on? And is it business friendly? So once we look at those 2 things, then we'll actually get a little bit more detailed and say, okay, the team looks good and the market looks good. So what do they have as far as this particular project? So what we look at there is, what is the deal metrics? So talk about your ROI, returns, things like that. And then what's important now is to look at your debt, right? So a lot of you guys probably seen the interest rates go up in the past 18 months to 24 months. And if you have something called floating rate or variable, you could, that's a little bit more risky. So is it floating rate or is it fixed? Is there a preferred return? Meaning, is there a split? I'll talk a little bit more about that, but what a preferred return means that is the investor gets paid first, this amount of money, maybe 6, 7, 8% before the sponsors get anything. So at least that prioritizes the investor in the deal. What is the business plan? So is it, we're just going to buy this property, not do much to it and hold? Usually that's not a strategy, but sometimes people do that. Or is this value add? So value add, like we talked about, a couple of different ways to do that. You can renovate, you can cure deferred maintenance, you can create new units, you can create new income streams, maybe parking or cable contracts, things like that. There are different ways to be creative there. Implementing a RUBS program, for example, if you tenants are not paying for their own utilities for water, sewer, trash, then you can actually build them back, and that can be a separate income stream, which can actually add up over time. So what are the ways to invest? There's actually a good handful of ways. One way is to just do it yourself. So you can find deals on your own using a realtor or online resources like LoopNet or CoStar, Crexi. That's on more on the commercial side. But of course, you can do your own residential project as well and then talk with a residential realtor. The pros of that is that you can own it all on your own. So you have a project, maybe it's 2 units or 4 units, or depending on where it is, and it's all yours. So all your gain is yours. You can make all the decisions with it. Cons, usually, you know, one limitation is you might get into a smaller project, right? Because you're one person or, you know, you have, you know, a certain amount of capital. And so you have to decide, okay, how big you can buy and where. Uh, Second way is to do it turnkey, and there's usually a lot of turnkey providers will be in, I'd say, states outside of California, so maybe the Midwest or the South or various different states. And the basically how that works is somebody sets up a property that is just cash flowing day one, and you don't need to do any work. So actually, you know, relatively passive. The pro is ownership, so you can own it all yourself. The cons are the size, so you might buy. I've seen a lot of these being offered as houses, for example. You buy a house, you know, eventually get a single family portfolio of 3 or 5 houses. And it's kind of, you know, it's scalable. You can do that as well. Sometimes you might be in an unfamiliar market. So for example, I know some people who have done some of these turnkey houses and they've never been to the market. So, you know, are you sure if it's a good market or not so good market? Sometimes it's a little bit hard to figure out if you need to travel out there. Another way of doing this is a joint venture, similar to doing it yourself, but basically you're partnering. So maybe you have, you know, not just yourself, but, you know, a friend or family or some other people, and 3 or 5 people pull together your money and then say, hey, we have this amount of money that we can invest, and let's go and buy something. Pros, you can get into a larger property, for example, instead of buying 2, maybe you can buy 5 or 10. You know, the cons, sometimes control, right? So they talk about, you know, joint ventures kind of like a marriage, right? You're kind of in the deal for a long time, 3 years, 5 years, maybe even longer. So, you know, want to make sure that you're partnering with the right people and that you're all aligned and have the right values, because, you know, things might go wrong. Hopefully they don't, but, you know, those are some things to think about there. And typically with a joint venture too, it's important to know that people need to be active. So, you know, that kind of brings to the next point, but in a joint venture, typically they're only up to a certain size because there's only so many jobs people can do in investing, right? Somebody finds the project, somebody manages it, maybe somebody talks with investors, does the cost, et cetera. But it's really hard to have a joint venture with, you know, 10 or 20 people. It's just, you know, you only have so many jobs in a particular project. Last one is syndication. So that's kind of the topic for tonight. What you got to do there is leverage somebody's skill set. That could be their track record. So they've done this for a certain amount of time. They've done this maybe 5, 6 times, and there is some history of showing you that they can continue to do this again. It's, you know, similar to a joint venture, except on a larger scale, right? And you can have, for example, you know, 10, 20, 100 people investing in a particular project, which can be pretty large. And generally, when you get scale, you can actually get better management because management is more incentivized when they can make higher fees from a bigger property. Your expenses can also be spread out more. For example, you can have a dedicated manager and a maintenance person, even multiple people at a particular property. And that can provide actually better service for your tenants because you have dedicated staff, almost like a company, right? Versus just, hey, we're gonna buy this and run it ourselves. So it actually can be less work. And there, from the investor side, actually is basically completely passive. You know, similar to turnkey, but even more passive, where there is no decision making really, and not having to deal with any management. You know, con there is the lack of control, right? So as a passive investor, you don't get to make some of the bigger decisions of do we refinance, do we sell? You know, if we want to invest in major CapEx projects, things like that. So there is kind of that lack of control there. Market research. So we're just going to talk about a market that we like, that we've invested in. As an example, we can talk about some metrics there. Anyone familiar with Ohio, Cincinnati at all? Not too much. Okay, so this would be some new information for everybody. We happen to invest in Ohio and specifically Cincinnati. We like the market. But in general, these are some things that you can keep in mind of any market, right? Maybe you like Texas, maybe you like Florida. And who are the employers there, right? We just kind of pick Cincinnati because we're there. So for example, there are 6 Fortune 500 companies in Cincinnati. Actually, the fun fact is that Cincinnati has the highest number of Fortune 500 companies per capita. The city's got about 300,000 or so people, but the actual greater metropolitan area is about 2.2 million. So that's kind of the total population in that area. Most of you probably know Procter and Gamble. That's a big company there. Anthem, Kroger, a couple major employers there. There's also biotech in the area. A couple of these public companies, Chemed, MedPace, different employers like Humana, Patheon. It's actually growing healthcare and biotech community and industry going there. Our renter profile, so it's good to see, the level of education, the typical income demographic there. Is it affordable, right? Especially, us coming from California, this is a less affordable place compared with a lot of places in the country. What's appealing about the Ohio area is that it's actually in 2019 was ranked lowest cost of living of any major metro in the US with a population of over 2 million, which, is a pretty nice stat. So people have disposable income, they can save, they can do their retirement, and they're not, overly stretched just by paying rent. And the rents are, below some of the major cities out there. Looking at average rent here, $1,000 compared to LA, that's, not a whole lot. So pretty affordable for people. And rent's actually gone up by about 6%. These are just a couple of developments. If any of you watch, football or soccer or sports, there's a new stadium built there. Amazon Hub was built there. $1 billion project bringing in industrial. So there's logistics demand there. So that's a little bit about the market. And, if we have some time to talk about a case study.
Yeah.
Okay, sure. So this is a project. It's just not an available project right now. It's already done, but figured we can share a sample project of what, a syndication might look like, or a sample, idea of what this could be. So we talked about this market that we're in, Cincinnati. So this project that we did was 41 units and in the city of Cincinnati. It actually has a number of different unit types. So you got studio, 1 beds, 2 bed, 1 bath, and 2 bed, 1.5 bath. So quite a good mix, pretty diverse. How we found it. So it's pretty common on some of these larger properties that you find them through a broker. Some of you might be looking direct to seller to source some of your deals, but on the larger ones, I'd say probably 40, 50 plus, you'll generally find them through brokers. Still possible to find them on, direct, but anything bigger, kind of the brokers have a lot of those relationships. Location wise, so it's pretty close to the freeways out there. Think like the 10, the 5 out here. So it's pretty well located. It's about a 10-minute drive from one of the major malls there. It's an A mall, pretty nice mall in that area. So this is a little bit about the numbers on the deal. So the price was about 2.6 million, and for our capital raise, or the amount of spots we had for investors, is close to about 800,000. Price per door is about 60,000. So very affordable and in this market in the Midwest. So we have our rehab. So we bought it for 2.6, and our rehab budget is about 150,000. And what our split was a 70-30 split. So meaning 70% goes to the investor, who is being passive in this project, and 3% for the sponsors who found the deal, put it together, did all the due diligence, and kind of closed the project and are managing it. These are some investor metrics here. So cash flow, so 8%. So if you put in 100,000, you get about 8,000 per year. Average annual return, so that's 18%. So that's going to include your sale at the end, and you divide that whole return by each year. So that's about 18-19%. IRR So think about your credit card, it's continuing to, compound, but this way, you're making money. So this is 14, 15% that's compounding every year. So your money is continuing to work. Question?
Yeah, you don't count as cap rate?
Cap rate. We did have a cap rate. I think it was maybe like a 7.5 cap rate, if I remember. So, yeah, great question. So cap rate, does everyone know what a cap rate is? Yes? Okay. So basically income divided by your price. We do look at that. We also look at, I guess the important thing with the cap rate is our cap rate higher than our debt? So I'll talk about the debt in a little bit, but we were about, I think it was about a 7.5 on our cap rate, and our debt was, a margin below that. But it's a good point there. In general, we want to show what the returns are going to be to the investor, which are these common metrics. At least, someone can say, okay, so for what you're putting in, 50 or 100 or whatever it is, you're going to get this amount. But definitely we do look at that. And if the cap rate happens to be lower, for example, maybe it starts at a 6, our goal is to get that cap rate up to, 7, 8, over time, because that way, that's how the property will actually be profitable. The problem right now with a lot of properties is that your interest rate is at 7, your cap rate is at 4 or 5. So basically you're underwater, right? So negative leverage, exactly. So that's kind of the challenge now in today's market, which is why it's a little bit slower. So in this market, and that's why we like the Midwest, is that our cap rates are still higher than debt, but not all projects. So we kind of have to look at the right ones. Yeah, so a couple of our value add strategies on this one: increasing rent. So typical renovation program, we're going to put in vinyl plank flooring. I think I have some pictures coming up. Paint, new appliances, new cabinets, and we can see what the difference is between unrenovated and renovated. Basically, we're comparing those rents and saying, okay, we put in this amount of money, we can get this amount of rent after we finish that. We also plan to do some unit conversions. So actually, we've already started some of these. There are large 1-bedrooms. So I think they're maybe 700, 750 square feet, and they're just 1-bedrooms. And what we did is basically put a wall in the living room so that can be converted into its own separate room. So we put a wall, put a door, make sure there is access and a window there, and we can actually get the rents up by about $200 or $250 by separating that. And then overall, the value of a 2-bedroom unit is going to be significantly more than just a 1-bedroom. Property was pretty well occupied. I think 92, 93% occupied when we took over. We did have some Section 8 tenants, and the benefit with that actually is that it's paid by the government. So these rents are basically going to be guaranteed. The tenant is going to pay their portion, and you just have to worry about collecting that. The rest of it's covered by the government. In some cases, the tenant actually pays nothing. So it's all coming from the government, and it's pretty, basically guaranteed money. Talk about location highlights. Our team there, we have 7 years of experience in the market. Total portfolio is about 150 units there. So I've grown that over time. Some of the risks. So if the voucher rents don't increase as much, I think there was maybe a 10 or 15% increase from 2021 to 2022, which was really huge. There was such demand for Section 8 that they actually would pay bonuses, which was pretty uncommon. I don't think they're doing the bonuses now, but it was pretty good program to be involved with. So the property is the workforce housing area. So we definitely had to budget for repairs, and do our due diligence before getting involved. Yeah, so this is just a summary of how we did our value add, what our strategies are. We're renovating units, curb appeal, improving the landscaping, making it look nicer, converting these units. So we actually converted 3 units so far, and we are getting our rents up, controlling the expenses. The the prior owner had pretty high expenses on the property, high maintenance expenses and high landscaping, and items were quite high. So we aim to reduce that and be more optimal. And over a 5-year period, we increased the value by, our plan is to increase the value by close to $1 million. And that is calculated with a 7% cap rate. And that's kind of the big picture of how you increase value, all these different ways of increasing the value, and that's how the property's worth more. These are some photos of the renovated units. Our debt, so as you guys all know, there are a lot of rate hikes over the past 18 months, 24 months. We did what's called agency loan. So that's like a semi-government loan. We got our interest rate at close to 5%. It's not this low anymore. So this was last year's rate, but we got it and we locked it in. It was quite a good loan. So we have this loan for 5 years. And what's nice is that we get interest only for 1 year, meaning that we can do our renovations, complete our plan, and still have 1 year of buffer while we're getting cash flow and reinvesting into the project. Also, we wanted to make sure that we have a flexible prepayment. Sometimes when people get their loans, they don't think about what happens when you sell the project. And you can actually get a lower rate. I think you can get even below 5% at the time if you got a more strict prepayment. But if we wanted to sell at some point or do a refinance, it's hard to do that with a lower rate and restrictive prepayment. So we wanted to make that flexible. This is an example timeline of what happened with the project. So we signed the contract sometime last summer, about close to a year ago. We did our webinar, presented this to investors, and then we opened it up. We did our capital raise, so open it up for investors for about a month. And when people make their commits, then they're invested in the project. And then we closed. So total time frame, 60 to 70 days. Yeah, and that is the project.
So, before we get into the Q&A, we'd like to have a couple questions for you specifically. I have 3 questions for you with Bill. So my first question is, as a passive investor, what's more important? The actual deal itself or the team that I'm investing with?
Yeah, great question, Jason. So I actually think it's not one or the other. I think it's actually both. Because you might have a team that has done a bunch of projects, and it's likely that the project is also good. But for me personally, I'd also like to individually evaluate the project. Now, if you are just going to pick one or the other, I would probably pick the team. Looking at their track record, looking at their experience, what they've done before, who's on the team, are they experienced in this market, versus just saying, hey, sometimes people can get into trouble with a project that has really great numbers, right? Oh, this is a great, cash return, and I'm going to make, a bunch of money on this. And they don't quite look at the team. Maybe the team doesn't quite have the experience, or this is, they're experienced in, Texas, but they're brand new in Florida, and, it's a different market, different things can go on. So I would say both, but if you're just looking at kind of one, I think team, maybe kind of team first. Yeah.
Okay. My second question is, okay, so this is my first time investing as a passive investor. I have 50, 100, 200, $1 million to go and invest in the deal. Now, how can I double check? How can I make sure that I am investing in people who are not only competent but also trustworthy individuals?
Are you still on a question?
Yeah, no, great question. So, yeah, there's a lot of opportunities out there, and obviously, this is like a marketplace, right? You can go to a stock and say, hey, I want to, should I invest with this manager or that manager? So I think it's, I mean, the easiest way to kind of probably vet somebody is to see, what their experience level is, right? So maybe look at their deck, maybe look at their website, see if they have done any webinars. Do they have, what's popular now is a podcast, right? Are they sharing knowledge with people and saying, hey, this is how you do investing? These are markets that are attractive. Are they, keeping up with the news of what's going on? And then I think just talking with the team. So who's on the team? Is it a few people, getting to know them? It's, different events, networking, phone calls, things like that. So different ways to connect, and then always, understanding, okay, what's the track record of this person? Sometimes people do, background checks of saying, hey, is this person who, we think they are they legit? Looking at their LinkedIn or, this and that. And another one would be getting references, for example. You can get references from different investors and say, hey, have you worked with this person before? What's that experience been like? Is it good or okay? And how did they manage your investment? I think a good one too is, has anything gone wrong, right? Because one thing they say in the real estate industry is if you have, if you've not run into any problems yet, you in real estate, you probably haven't been doing it long enough. So what are things that have gone wrong and how have they been handled? So, for us, plenty of mistakes, mostly on our own dollar, luckily. So try to do other things, but always a good way. And if somebody's brand new, they probably don't, maybe have something to talk about there. So it's kind of hard to figure out how they address it.
Okay, so I have one more question for you, but I just thought of something right now. Which,
question, brother. Come on, man.
I'm sorry, I gotta ask it. I gotta ask it.
Here. I want to ask you a question. We have a question.
Yeah. So, 30 seconds. What was your biggest mistake, and also what did you learn from that mistake?
Yeah, good one. So I think when we were getting into this business, one of the first properties that we got, we generally knew we had some kind of plan, but it was a general plan of, okay, we're buying this at a nice cap rate and it's going to cash flow, and we think we can move the rents up. And that was kind of the plan. Then we didn't have specific numbers of, okay, what's the CapEx budget? Rents now, we knew what that was, but what is market rent? We thought we had a good manager and we asked them a bunch of questions, but apparently they didn't quite size up to what we're expecting either. So what happened there? I mean, sometimes if you're in the right market and the right timing, that can help a lot of things. So with that particular project, it was a 12 unit. So sometimes we would get low on the cash flow and say, oh, we got to pay $3,000 or $5,000 to renovate this because somebody left. So we'd have to come out of our pocket to do that CapEx budget, or say, hey, this month we don't really have a distribution, so let's just put the money in the account. So definitely budgeting. I think budgeting is really, really important. Doing your due diligence. So getting an inspector to go in there and, even beyond that, get a roofer, get an electrician, get a plumber, just get all the professionals, unless you're one yourself. But definitely, do your due diligence really well, do your budgeting really well, vet your property manager. So they say property manager can, make an okay project a great one, or can make a great project a bad one, right? So we've, had lots of problems with managers, and, once we identify, hey, they're not making the cut, they're not, getting the plan done, we just have to swap them out. So those are, some of the things, but I could talk for a while, so.
Jason, keep asking questions for a while.
We even have a question online, actually.
Right, exactly. We have a question online over here.
I got one quick.
Right?
I
I just
My
got one
question-
question.
Great question.
Quick question.
Mr. Lee, my question is, if considering getting into this field or, investing, what would your recommendation be on the minimum for a person to get into this comfortably? What amount would you say would be like a base starting to if they wanted to get into this line of investing?
Yeah, is your question about if you,
A minimum requirement for a passive investor,
oh, for passive investor, okay.
what it sounded like,
Okay, minimum investor.
Yes,
for-
that was it.
Okay, perfect. So for our group, we're a minimum of 50. And that usually is gonna be for 5 years. So most projects, syndication is going to be a 5-year hold. Sometimes you might see something before that if you do a refinance or if you get to your returns, your target returns before that, then you'll return that. Different groups will have a different minimum. So some out there will have a 75 minimum, or even I've seen some people with a 100 minimum. So it depends on the size of the project. I would say as the projects get bigger, usually the minimums get bigger. Right. On a smaller size project, I'd say probably 90% of the ones I've seen are about 50. You'll have a couple of projects. I mean, Dexter, you can share too. You did a
right on something with Grant Cardone.
project,
Yeah, he had a minimum investment of $5,000
yeah.
for non-accredited investors.
Mhm.
Yes.
So yeah, so 5,000, I think that's very accessible. And then now you'll have some online providers too, where you can invest, I think maybe 25, maybe 5 to 25. So I would say, invest what is most, feels comfortable for you. And two things to think about are, one is if you're accredited or not accredited. So if you are accredited, you can get access to more types of opportunities. They're called, I didn't get into this detail, but 506C, which is only accredited investors, certain amount of net worth, certain amount of income. Then you get access to pretty much every kind of investment opportunity. 506B, so those are the ones that we've been doing. You can have a certain amount of non-accredited investors and no limit on accredited investors. But yeah, I think, it's important to just invest at your comfort level. And make sure that, you don't need this money for whatever the period is, right? If you're saying, hey, I need this back in a year, maybe you don't want to do syndication. Maybe you want to do private money lending or flipping or something more short term. That's less than 5 years. But for syndication, it's important to think not just dollar amount, but also how long you don't need the money, or if you're just gonna, keep investing it.
Okay, thank you.
My question is, what if one of your general partners get into some legal trouble and have to go to jail? Would you quietly replace him? Or would you let the investors know what's going on? Real life scenario question. Real life scenario question.
Yes. The go to jail question, yes.
Would you replace him, or would you notify your investors? They say in this business, bad news is better than no news, right?
Yes. So I agree with that, Dexter, is, different sponsors have a different philosophy on communication. For us and our team, I would say communication is really important. Right. So, of course, everybody wants to hear good news. Let's always talk about that. Neutral news is just, hey, we closed, we're on track, planning, whatever. Or bad news, right? Maybe we're not on track, but, hopefully it doesn't happen, but, cash calls, stuff like that. You've seen some people in the news where they ran problems and they didn't tell anybody until it was too late, right? So, sometimes you'll see that, and I think it's good to be proactive, right? Because even with the right communication, you can prevent some of those problems, right? Just tell your investors, okay, maybe we're having some kind of issue here. Let's work together and solve it versus, hey, we're just gonna sweep this under the rug type of thing. So some type of announcement. One of the GPs did something wrong. They're going to jail, I guess, and we're going to replace this person. I think what's important is at least it's out there for the investors and saying, how does this impact you as the investor, right? Is your money still safe, right? And hopefully it is, because this person didn't run away with it, right? So Assuming, hopefully the bad news, the worst news is that the guy's going to jail, but your money's still. Your money's still. Hopefully that's, some good.
They're gonna chase after his assets, you know?
That's cool. I don't have any more questions. You can take the questions from the crowd.
Yeah.
Yeah, so I was just gonna want to clarify the loan that you mentioned on the case study.
Yeah.
Was that a balloon? Yeah.
It's a 5-year fixed rate. And so at that point, it's going to reset in 5 years. So, typically that'll mean it'll reset to whatever the rate is at that time. So, so basically whatever your term is going to be, you can choose 5 or 7 or 10 years. It's going to be fixed for that amount of length.
What was the mix of your team there on this project? For example, who was the local people and who was like other people on your team that were local here in California? How was the mix of the team worked out?
Yeah, sure. So, being here in California, the team is really important because, we're not there. It's hard to just get there, right? So we do have local property management. I didn't put them on here, but local property management that we've been working with for a couple of years. We have had to change management companies in the past, but it's a process of almost like, changing people in your company, right? Some will work and some don't. And so it's really important to have the right property management team. And not just property management team, but also having other resources there. So I've got a broker there, I've got a lender there, and we've got, other investors that can say, hey, can you, double check that these things happen or drive by, right? So at this point, being there for about 8 years, I've developed a network of people to say, hey, can you, come on this thing, or, contractors that can step in and help. For me and my team, we're the lead on some of these projects. I travel out there about once a month. I've spent a couple weeks there at a time if we need to do our due diligence or hire people or interview or meet with other, investors, partners, brokers there.
Physically go there and
Yeah.
okay.
I would say some people do it differently. I know people that just, buy a house sight unseen. We tried to buy a property without going there, and we learned it the hard way. It was, oh, these pictures look great, and this is gonna be like a 10 cap, all kinds of money. And went there, and there was like a violent looking dog. A guy had a gun, and he had a hole in his roof, and we said, no, we're not buying it. So we learned it the hard way, lost some money, but my philosophy, better to not buy something bad than buy something bad and have it go worse.
So you source out the crew except the property management, like you have your contractor and plumber and electricians outside of the property management. So if you need them, they can step in rather than, a normal property management that they will source out, a rehab guy, a plumber, electrician, whatever they need.
Well, so actually we've done it multiple ways. So either we have property manager and we have some separate rehab people if we need that. So as we get bigger into properties, our goal is to find property management that can do everything and have all the vendors, because we from here, and just because there's, so many things going on, we don't want to be calling plumbers or calling contractors.
Exactly.
So we want that's one of the benefits of getting into a bigger property and a syndication, because when you're, I own some properties myself on the smaller scale, and I actually have to do more work on those ones, calling my own contractors and, finding different maintenance or rehab people. I have to do a lot of that myself for my team, versus when I work on, 80 or 100 units, it's almost hands off because property management does everything. And they actually coordinate it better because they're doing the leasing and they're moving tenants out or moving people in, and they can coordinate the rehab. So what we're doing at that point is not management, we're doing asset, which is just overseeing the managers there and making sure that this is our plan. Let's make sure that we're on track instead of we're actually doing the plan, if that makes sense.
Yep.
So that's kind of the goal eventually of scaling, and that's one of the big benefits actually of being part of a bigger project passively.
Any more questions?
I got one question. Regarding to the one project you had, what is the percentage of the due diligence and then fees? Of the loan, like, and how's that covered? Do you pay for that or is that you raise it too?
Yeah, so what we'll do is we'll collect all the fees together, right? So it's a bunch of fees. So you have due diligence fees, you have attorney fees, you have lender fees, acquisition fees, all of that just goes into all the work that goes in. And then we'll put all that into the total cost. So the total cost is gonna be, let me see what the cost is in here. I think 2.6 or 2.7 or something. So we put all that into the cost, including the rehab. And then that will be the total raise that we need to do. And we'll say, okay, the sponsors are gonna put in this amount of money, and then the rest of it is gonna be raised from the investors. So that's kind of, split up between everybody who is investing.
What is usually the percentage of all that fees usually cost? related to this
Percentage of the
project?
fees, I put a chart in here. For example, so diligence can be, it varies, maybe, a percent, on diligence fee. Legal costs can be anywhere from, 15 to 20,000 if you're doing, PPM and getting your legal docs, attorney for the purchase and sale agreement. Fees on acquisition, that can be like 2 to 3% usually of the purchase price. Asset management fee, for example, that is somewhere between 2 and 3% of your gross income, and that's for the team to watch over property management and make sure everything's going okay. Lender fees usually about 1.5 to 2 points. There's origination fees, and then they also have their lender legal fees as well. So those are some of the big ones.
16%, yeah.
Yeah.
So on this deal, Wakefield, you actually, the actual number of individual LPs is only doing the math, it's not that many, right? If everyone's putting in 50 or,
Yeah, so this one, was it like 15, maybe 15 or 20? Yeah. So 15 or 20, that's at the minimum. So we had some that were, I don't think we even had that many. I think we had maybe 10 or 15. So, some people are 50, some people are 100, some people are 150. And then, but usually, we'll break it down as a unit, right? So 50 gets you 1 unit, and then you get, if you're 100, you get 2 units. So that's kind of the general increment.
Yeah, so, just clarification on the 70-30 split, so, 70%, so it's a higher percentage split than the investor because there's more investors, right? And then it's 30% because there's less sponsors, but each person gets the same amount of return on the amount of money that they put in, right? The sponsors and the investors each get the same percentage rate of return.
Yeah, very good question. So on I don't think I put a preferred. I think we had like a 7 preferred and I didn't put on here, but so 70-30, what that means is, let's say you have 1,000 of cash flow and $700 goes to investors and $300 goes to the sponsor team. There's something called the sweat equity. So sweat equity for the sponsor GP team is for putting together the deal and doing the asset management, making sure the plan goes right, making sure that you as the investor, get the return here. So I don't have that GP split, but the GP, I guess the first return is to look at this investor return. So this is net of the split. So after the 70-30 split, this is what the investors get. The GP split is a little bit different. It's going to be a little bit higher because of the sweat equity portion. Does that make sense?
Yeah.
Yeah. But this is net. So net to the investor after the 70-30 split, preferred is going to be this. And usually we're focused on this number because, this is the kind of the opportunity that we're presenting to people.
Yeah, what's the highest difference you've seen the sponsors get? Say like this is 18% investments.
Oh, so what have I seen as a return range?
Yeah, as like a sponsor, like this example, the investor gets 18% annual. What's the highest difference you've seen like the sponsor get considered the swag? Like in this example, 18, and then the sponsor gets 25. know, like what's the highest?
Oh, I get what you mean. Yeah, it varies. So, I mean, usually it's more in a multiple. So as the GP, your cash flow is actually pretty low. So sometimes when people think, okay, in LP, you're getting this and your sponsor must be making like tons of money. So usually it's lower, usually it's lower on the cash flow, but you'll get more at the end.
Right.
And the reason for that is to make sure that your GPs are invested, right? Because if your GP is making, I don't know, 15% cash flow, they might just be saying, okay, well, I'm making great money and however the deal goes, right? So, but to incentivize the GP, usually it's more on the multiple. Meaning you have to make sure you added the value to the property, did the plan that you told people are going to do, and then that's how you get the value. So equity multiple for a sponsor, for example, could be, 3, maybe sometimes more than 3. That's for the sweat equity portion, but it's a little bit, of a kind of like a seesaw thing is lower cash flow and higher on the back end versus investors get more now, and then they also get a combination of the upside.
And that 3% you mentioned for GPs is more on the back end after the sale, right?
After
Sale. That's when that GP can get that 3% or 3 times.
The
multiplier.
Right.
Yes,
So it's a lot of it's on the back end.
right, but for the general part.
For the general partner, yes.
So, I'm a doctor, I'm a lawyer, I'm an accountant. I really don't know much about real estate investing, but I want to get into a passive investment deal. I really like the team. It seems like they have a good track record. It seems like they are competent and trustworthy. But how do I know if their underwriting is actually feasible and realistic? Because anybody can actually manipulate those numbers to make it look great. So how do you know if the underwriting is actually realistic?
Yeah, so I'll go back to, let's see, how to evaluate here. Yeah, okay. So we evaluated team, evaluated market, so evaluating deal and business plan, I think is really important. So, well, the first thing I would suggest to people is just, get the education and make sure you understand how this works. Because that way it's like being more informed, right? It's a lot of money. It's not, small amount. So I think it's good to always get educated and know how this works. How do you know if underwriting is sound? So either you can, I guess there's 2 ways to do it. You can talk with the sponsor and kind of review. You can get their underwriting model and say, okay, these are the numbers. Now, if you haven't seen a lot of these, it can be kind of overwhelming. There's a lot of numbers.
Yes, it is.
So I think, there's just like workshops where you can learn about it or different books that can show you how to do underwriting. I think it's also good to compare, right? So, you don't have to invest in the first deal that you see, right? You can look at a couple and say, well, this one's like this is their rent, and putting $15,000 a door, and this one they're getting bumps of $300, and this one's doing $10,000 a door, and they're getting bumps of $150, right? So you start to get some idea. It's maybe like you're looking at stocks, you're like, oh, this stock is like this ratio, this is this ratio, and it gives you this dividend, that dividend. So I think it's good to look at a few. There's lots of books out there. Different sponsors will have like underwriting sessions, for example, of, hey, let's walk through this deal. Let's look at how we put the numbers together. So we share some of those, case study examples. But I think it's good to especially right now is a big one is debt. So what are you doing for your debt? What's your upside, right? Is somebody saying, oh, our rents are 1,000, we're going to make them 2,000. And then after that, then we're going to get to returns. Well, that sounds like a big increase, right? What if they don't get to 2,000? Then do you still make money or do you lose money? Right? So you might say it's more realistic to go from 1,000 to 1,200, 1,000 to like 50, right? But to figure that out, you really have to look at the market as well. So there's a lot to kind of look into. Yeah.
So very quickly, you guys, if you guys want to learn more about how to be a smart passive investor. I would highly recommend Brian Burke's book. It's called Hands Off Passive Investor. I would recommend that you guys read that book before you guys actually passively investing in these deals.
Yeah, great book. I recommend that one to a lot of people. Brian Burke's How to Be a Smart or Passive Investor book. Yeah, pretty detailed, and he's, you know, a pretty big syndicator, does a lot of projects, and definitely a good reference. I put this here. I don't know how much time we have, but if you guys are interested, this is just like a survey if you want to be added to our list and you know, see more about opportunities. We have webinars and share information about the market and things like that. So you just scan in here and it's a quick survey to be added.
I have one question. You said like the minimum lifespan of a project is 5 years?
Typically.
Typically, so has there been a time like where you decide to sell before the 5 years end?
Yes. Yeah, so that does happen, and especially that's happened in the last few years because the market has been really hot. So, you know, people buying in 2016, 17, 18, even like 19, for example, you know, COVID was like this huge spike in value. So people who had a plan of like, I would say most projects I've seen are planning for 5 years, but you know, let's say you get to 5 years and you hit your targets and you get there in 2 or 3 years, people will probably sell.
So I guess the follow-up question would be like, how does that work for the initial investment that's projected for a 5 year?
Do you mean like, how do they make the decision to sell or?
Not so much the decision, but I guess, how does it work for someone to invest if it's projected for 5 years, but you're selling within like, let's say 3 years?
Oh, got it. Okay. So if, so the GP team is going to make that decision. Sometimes two things can happen, right? So maybe you get to your numbers and you're ready to sell, right? That's one. Another common one is a refinance. So maybe you're not quite ready to sell, but you're doing a refinance, and then it's called a return of capital. So you invested 500 or 100, let's say, and you get, you know, 30 or 40 back, and then you're still in the deal for that amount. But you got, you know, a chunk of money back and you're still invested in the deal. The GPs need to tell you, right? So they're saying, oh, maybe we are thinking about selling ahead of time, right? And you know, the next year, maybe this is like in the third year. So we can tell you ahead of time, you know, help you out with their planning because there's like taxes, things like that to think about. And, you know, maybe you're not ready to sell, right? Maybe you're like, oh, you know, this is a little bit ahead of time and then you need to do your planning. But a GP will tell you ahead of time. But, you know, I think it's good to, what we tell our investors to expect your 5 years. And if we get there ahead of time, that's almost like a bonus.
I don't have a question.
We're good?
Yeah.
All right, cool. Thank you, Wakefield. Can we give him a round of
Thank you.
applause? A lot of knowledge, drops a lot of gems on us. Right?
Informative. Thank you all for coming tonight. Again, once again, I would like to announce we're looking for volunteers for snacks and parking. Wink, wink, Mr. Wakefield. Also, we're going to be announcing the winners for the gift card and
Yep, I got
few.
a few daily journals, gold book, 3 of them. Let me go. I believe we have 12 people here. So Ms. Ashton, I'm gonna start off with you. Pick a number 1 through 12. I gotta count these names now because they're in order, but they're not in order. So pick a number 4. All right, we got 1, 2, 3, 4. Catherine. Congratulations, Catherine. Yeah, number 1 through 12, Catherine. 10, all right. That is actually y'all working together. Y'all sitting together and working together. All right, this one is a question. Does anyone remember the IRR number on the case study that he shared? Does anyone remember that IRR number on that case study that he shared? Go ahead, Mark.
14.9,
Was it 14.9 on that case study, Wakefield?
just under 15.
What was the IRR? 14, what? Sound all right? All right. Thank you. Lead on. Last but not least, for gift card, Starbucks. What is Wakefield market that he invests in? Yeah. All right, let's think of something else. All right, what was the interest rate on the case study that he shared? The interest rate.
5 point something.
Hey, let's start with the book, man. You can't say. Yeah, all right. But he said it over there. I'm trying to be fair there.
What else?
All right, come on, Marcus. He said, give it to you. Good job. Thank you, thank you. All right, everyone, I want to thank y'all for coming out, opportunity to network. Can we get another round of applause for Wakefield? Are you gonna stick around and network? I'll give the cards to pass out.
Yeah.
You have any announcements, Brother Jason? Oh, group photo. Can we come up together as a family, as a real estate investor family and take a group photo up here? On one camera. Hey, social media world and we on Zoom, right, Mark? Max?
Yes, yes.
All right, to the people out there in Zoom, appreciate y'all. Right on. Now who gonna take the picture? Who gonna take it? All right, you got it? You sure? All right. Max, you got all the picture on here, man?
It's on the screen, it's right
You
there.
got all this high fly
And it's being
technology.
recorded.
All right, we're gonna look, talk to us. Come on, Fancy, talk to us. Everybody smile now.
All right, smile. Hands up in the air. Scream from joy.
Yeah.
Yeah.
I've been on Zoom, been here the whole time. He just slept.
Evan Davis?
Edmund Davis said
That's my cousin.
Is that your cousin?